So let's look at one of the most popular patterns in technical analysis, the head and shoulders pattern. The head and shoulders pattern could work either as a reversal pattern or a continuation one. We will look at both. We will discuss the head and shoulders reversal pattern for a rally first, as opposed to the inverse head and shoulders reversal pattern seen on bear runs, since the latter is a mirror image of the former and mostly the same principles would apply. The first point to remember is that the head and shoulders pattern is a long-term pattern, as reversal patterns take longer to form than continuation patterns. Simple law of physics tells us that it takes more effort to reverse the direction of something in motion rather than slowing it down. The first formation of the head and shoulders pattern would be the left shoulder. We know in an uptrend, the peaks and the troughs are ascending. However, in this scenario, the peaks and the troughs gradually start to lose momentum. The left shoulder forms a new peak. We can call that peak 1, where the distribution begins, causing prices to move down to point 2. Point 2 could be a 50% or a 66% retracement level of the original move to point 1 or a support point in the trend line. Now, we don't know yet whether this is the left shoulder and could continue to be a buy at the retracement. Now, on the next move up, the price breaks the previous high of 1 to form a new peak at point 3. Here, one might observe a low volume causing the price to move from 2 to 3, or a rapid sell-off at 3, such as a quick price drop and the absence of buying, maybe a reversal bar at the top, cautioning the trader that the selling is strong at 3 and there seems to be a lack of buying interest. Now the next move is crucial. The fall from 3 to 4 now retraces almost 100% of the previous move and stops close to point 2, the start of the previous move. Now this 100% retracement forms the head of the head and shoulder pattern. The line drawn from 2 to 4 forms the neckline. The neckline forms a support for the next up move to point 5. What's noticeable about point 5 is that it does not rise above the head or point 3, the peak. The failure to rise above 3 and light volumes from point 4 to 5 signifies a new downtrend. The previous trend line that supported the initial rally, let's call that trend line 1, now acts as a resistance for the down move. At this point, the longs start liquidating, realizing that the market is not rallying further and a move sideways is quite possible next. We had drawn the temporary support line from 2 to 4. This support line is called the neckline for obvious reasons and acts as a support for the right shoulder. If prices break the neckline and closes below this line, it constitutes a break of the neckline. Now this break on a closing basis completes the head and shoulder reversal pattern. Players can now expect a new downtrend. Selling should now intensify on the break of the neckline. A return move back to the neckline is also quite possible. Notice that this neckline, which was once a strong support, now acts as a resistance. Players who have not initiated shorts are waiting for the return move to start selling. Now this return move may not happen. So the return move, however, may not be seen if the breakout from the neckline is violent. If the prices drop rapidly with heavy volumes, the price may not retrace back to the neckline. The last point to note about the head and shoulders pattern is the minimum price objective. As we have seen from other patterns that volatility of prices within the pattern are used to measure the minimum distance prices are likely to travel on the breakout. Therefore, for the head and shoulders, simply measure the distance from the neck to the head top and project that from the breakout point to get the minimum price objective. So next we look at the inverse head and shoulders pattern, and we also look at some examples of head and shoulder patterns in live charts.